Have you ever wondered what really caused 2008 financial crisis? Most people will say the banks collapsed or Lehman Brothers went under. But what if I told you the real cause was not the banks at all? According to the economists Atif Mian and Amir Sufi, the biggest damage was done long before the banks collapsed. It was in our homes in the form of debt. In this video, we will walk through their groundbreaking book, The House of Debt, and understand how debt fueled the crisis and what lessons we can still learn today. This book was published by the University of Chicago Press in 2014, and it explains the real cause behind the 2008 financial crisis. So let's begin. In the first part of this video, I'm going to discuss the myth of the banks. After the crisis, many believed the solution was to fix the banks, inject money into them, prevent a bank run, and stabilize Wall Street. But Atif Mia and Sufi ask, if the banks were the problem, why did the recession hit before the big banks failed? Here is what they found. The economic downturn started in 2007, well before Lehman Brothers collapsed in September 2008. By mid 2008, people had already stopped spending, job losses were rising, and housing markets were crashing, while banks were still standing. So, what went wrong? The answer lies not in the skyscrapers of New York, but in the suburban homes across America. Let's go back to early 2000s. Low interest rates and easy lending made it very tempting to borrow. Millions of families, especially in low-income neighborhoods, took on huge mortgages. From 2001 to 2007, household debt in the US doubled, incomes stayed flat, but borrowing exploded. People were encouraged to buy homes they could not afford because everyone believed house prices would keep going up. And lenders don't mind. Why? Because they could sell off the loans to big banks, which turned them into mortgage-backed securities. This was the illusion. The system looked strong but was built on fragile debt. Then came the shock. Housing prices peaked in 2006 and began to fall. Families who had bought expensive homes saw their equity vanish. If you owed $300,000 on a home now worth $200,000, what would you do? Thousands did the same thing. They defaulted. They walked away. This is where it gets interesting. Mia and Sufi show that when household debt is high and prices drop, families cut spending drastically. They are not buying cars, they are not eating out, or they are not going on vacation. They are trying to pay off loans or they are being evicted. And when consumers stop spending, businesses start firing. Unemployment rises. It's a domino effect, all triggered not by bank failures but by over leveraged households. Let's do a thought experiment. Imagine person A has $10,000 in savings. Person B borrows $10,000 to buy a car. In the short term, the economy grows because person B spends the money. But if the person B loses his job and can't repay it, the economy shrinks. Meanwhile, person A does not increase their spending just because they are getting repaid. Me and Sufi explain borrowers have a much higher marginal propensity to spend than savers. In simple words, poor and middle class families spend more of every dollar they get, while rich lenders tend to save it. That's why when debtors get crushed, the economy stalls because they are the ones who drive demand. So, how did the governments react all across the world? They bailed out the banks. The troubled asset relief program injected billions into Wall Street, but very little went to help homeowners who were drowning in debt. Mia and Sufi argue this was a tragic mistake. Helping banks without fixing household balance sheets was like fixing the roof while the foundation was collapsing. They propose a different idea. Write down the debts, let homeowners pay less if house prices fall, let lenders share the loss. This would have kept people in their homes, it would have preserved spending, and it would have saved jobs. But instead we choose to protect the banks. Here is the author's revolutionary idea. They suggested a new kind of mortgage called shared responsibility mortgage. Here's how it works. You take out a loan to buy a home. If home prices fall in your area, your monthly payments go down automatically. The lender shares in the loss. Why is this good? Because it reduces risk for the borrower, it keeps people from defaulting, it maintains consumer spending, which helps the whole economy. And guess what? When the economy does better, lenders benefit too. It's a win win. This is not just about America. All around the world, from Spain to Ireland to Pakistan, countries have repeated the same mistake. Encouraging people to borrow to buy homes, believing it will make everyone richer. But when prices fall, the poor suffer the most, and recovery takes years. Mian Sufi's message is global. We must shift from debt-driven growth to equity-based growth. Let people share in the gains and the losses without the crushing burden of fixed debt. So, in my opinion, the house of debt changes how we think about financial crisis. It teaches us that the real danger is not just bank failures, it's household debt. Ignoring borrowers causes deep, lasting pain in the economy. We need smarter policies that protect the people, not just the institutions. And the next time we face a downturn, we must remember this. A healthy economy is not built on credit cards and risky mortgages. It's built on resilience, shared responsibility, and people who are not drowning in debt. If you found this perspective valuable, consider reading The House of Debt yourself. It's not just about the past, it's a roadmap for the future. And if you want more deep dives like this, don't forget to like, subscribe, and share this video. Thanks for watching.